Welcome to the Gray Report. I'm your host, Spencer Gray, and if you're a multifamily investor, active, passive in the industry, well, this is the YouTube show and podcast that's been designed especially for you to help keep you up to date on all the latest research, trends, data, and original opinions around the multifamily industry. Thank you for joining us. Make sure you are subscribed, like this video, leave a comment if you have any question about what we're talking about. Today, we're talking about the multifamily market and commercial real estate. There's some bright spots and some very dark clouds. We're also going to be talking more about commercial real estate loans, the difference between office, multifamily, and just some of the sentiment that's out there revolving all of these loans that are out there that are not looking too great right now. Also, let's talk about AI, commercial real estate, ChatGPT, Bard. I'm sure you're playing with it. We certainly are here at Great Capital. So we're going to kind of dive into what are some of the use cases. Are there answers and searches of problems? Let's get into it. Let's find out. All right, let's do it. Welcome back to the Gray Report, joined once again by producer, director of communications and marketing here at Great Capital, Dr. Matt Bosnagel.
Hello.
How you doing, Matt?
Pretty good. How are you?
Hanging in there. Things are good. I'm excited. I'm motivated. I'm seeing some more clarity, even though things still can appear murky. Things have been coming into focus for me, at least over the last week, which I actually think is different maybe from prior weeks and months. And I don't know, just because we've been looking at this every day but I don't know, I see a little more clarity. I don't know why, but I mean, we've got some great reports. What do you think going through things? Am I completely off base?
Well, I think that a lot of the stuff that we thought was there was potential to happen seems like it's really clear that it's going to happen.
Yeah. And then not necessarily clarity on good things, good things, some.
Yeah, and I also there's a clear consensus across a lot of different sources that things like this loan situation in commercial real estate are coming to a head. Yeah. I think that we're going to see some movement of these owners that have a shaky debt situation, and they're hopefully going to start figuring out solutions. In previous weeks and months, really for the better part of a year, we were talking about how everyone's waiting and seeing, and there's so much talk about it. There's got to be some movement or else.
Yeah, and I think that the big question is to what extent? Because I mean, it's a math problem. At the end of the day, it's really just numbers, and then there are some relationships that are involved. But at the bottom line, some decisions are going to have to be made near the end of the year. We're going to be entering a period where we have a ton of maturities, and we know, I mean, office is the best and worst example, the worst case example of how they're on floating rate loans and the valuations have just plummeted, and the future opportunities in office are so uncertain. No one is really lining up, except a handful of people who are interested in just like the basis play of there's going to be a fire sale. Yep. And certainly as any entrepreneur, you have to think about that. And there's been a lot of discussions of repurposing, but we know the challenges of that. But it's like you buy it, but what are you going to do with it?
You put it all with the computers that are going to run our lives.
You put it, maybe that's where we turn them all into data centers.
Yeah.
It honestly makes a lot more sense than apartments in some cases. I haven't looked at a case study, but offices, it's a really tale of two cities. If we're looking at like office and multifamily, where there's the distress is coming from, the increase in interest costs and, the 2 to 4% range where folks were getting debt 2 years ago, 18 months, 2 years ago, and now call it the 6 to 9% range that they are in today. Plus, there's been rent growth, but NOI growth hasn't been as strong because expenses are up. In offices, you've had, certainly NOI declines. You're going to have other problems in hospitality, pressure from wages, repair and maintenance, all of that's up. So the underlying problem across all commercial real estate is just, the interest expense is so much more than it was. And depending on the underlying kind of financial conditions of that property, you are in a situation where if everything has gone perfectly, you are able to barely refinance and roll your debt.
Yeah.
And even some cases where everything has still gone perfectly, you may still even have to bring some money to the table to refinance, but it may be marginally. If things are just going all right, you're going to have to bring a chunk of money to the table to refinance or sell it, which people are going to have to be exploring very, very soon. Or you work something out with the bank, they give you an extension, or the worst case scenario is you actually have to hand in the keys because the gap is so wide. It's just like you go take it to the market, and we're going to find out soon of how many buyers are in the market and for what.
And that's what you were saying. It's coming at you from this declining NOI and thus valuation.
Or even, and some NOIs are up marginally, some are flat, and some have declined.
But you're not, and usually you would think that you'd have increasing NOIs.
Yeah, absolutely.
But at the time when we're having high interest rates, it's a little bit of almost like a stagflation thing where you get high interest rates, high inflation, a little bit of stagnation in terms of like the rent growth, and they're all coming at this. Things are still so frothy. What's funny is that in this Collier's report, they have singled out really retail is one of the only asset classes where investors can find accretive financing. It's like
services, that service-oriented retail. That essential, the nail salon,
and it's not
restaurants, and
it's not like retail never was a superstar for the pandemic. It never had its time in the pandemic. It's always a little bit underplayed.
Well, when everything was shut down, you couldn't, at least apartments you stayed in, and people were paying the rent. They're getting stimulus dollars. Retail, like, the businesses were shut down.
But it almost seems to inure the retail sector from this volatility that we're seeing in other sectors, like in industrial's a little shaky, but still relatively promising. But like we're having to seesaw in a lot of different other sectors. For office, it's just a plunge.
Off the cliff.
But for many other ones, it's up or down, and retail has just been kind of continually just building up a little bit and a little bit. Now, Colliers is not incredibly optimistic about the pricing for retail going forward, but I don't think that...
they're saying basically pricing direction across all sectors, except for hospitality, according to MSCI quarterly pricing direction, but every other sector of CRE, they are forecasting pricing going down, which is not surprising going into, again, this wave of debt maturities.
But yeah, my understanding, at least for the retail, is like, I think that there's like, people say priced to perfection, and it's this idea of
where's money going to be flowing if it's a few things.
Where's it going to be flowing, and how much can you predict things? And I think that in a strange way, retail has arrived at a conclusion that has yet to be arrived at in something, especially like the multifamily market.
I do think there's probably a ceiling on the investor demand for retail. But I definitely think that it's going to be at that ceiling. I don't know what that ceiling is.
And the waters are still choppy. We still haven't, it's not smooth sailing for any of the other ones, really.
No.
It's hard to make a prediction for even something for like industrial, which I think that all signs are like it's still pretty good, just not as incredible.
Yeah, I agree. And because, something I was listening to recently, the people we're cutting back on major, expenditures. We're not buying a new car, we're not buying as many new houses. But we still are spending money at the nail salon, or at the barbershop, or we're going out to eat. People are still taking vacation, which is different. I mean, that's more in the hospitality, but people are still going around and spending some money. They're just not, they're taking away those big purchases. But retail is still very cyclical. And so that's where there's going to be some investors that just don't have the stomach for that risk profile. But I agree. I think that you can find some really strong risk-adjusted returns in retail. And I know there's some really smart folks that are doing that right now. It's not our area of expertise.
But
I think it's a good play right now for sure, Matt.
Also,
it's on this chart, Matt. I think maybe
my eyes went right to it.
Just looking at some of these loan maturities, breaking down per asset class, and we can see, as been reported many times here on the Gray Report, we got a lot of loan maturities coming due in this year, really starting to peak in October. So we're going to see movement a little bit before October. Some people are going to have to make some decisions before the actual date. But then we still have a lot in 24, in 25, significantly less. In 2023, we've got around $700 billion in loan maturities. Am I reading that correct, Matt?
Yeah, and another thing too, which is interesting about this chart, it does have a little bit of a breakdown of which of these which of these sectors have the most loan maturities at a given moment. So multifamily is a little under $200 billion in 2023, and it jumps to about 250 in 2024. Now the big chunk for this year is office. It seems like at a little bit more than the multifamily, probably close to 200, whereas multifamily is a slightly smaller slice this year.
And while multifamily, obviously, again, different fundamentals, we can't ignore that, a lot of the lenders, especially in like the bridge, debt fund space, on the private lending space, CMBS, there are a lot of the same investors and the same lenders. And so if credit is tightening, which is tightening for other reasons, less money for, what if they have a bunch of bad office loans, they're really going to be looking at some of their multifamily loans as well. It's going to be probably a bright spot in their portfolio. But again, that's where there may be opportunities. They may need to sell some of these loans.
Yeah.
There could be some opportunities there. The next, again, 23 through 24, with office really hitting us in a big way later this year. But then, maturities, it really trickles out, which makes sense because a lot of loans are relatively shorter term. So it's, there's going to be new loans originated.
Yeah.
But you've also seen there's going to be a gap of maturities for a period, a year to 2 years from now, because no one was doing deals. No one's been doing deals the last 9 months.
Yeah, and that's another, and that's something that
certainly not nearly as many bridge loans.
Yeah,
also,
and I think that's going to affect supply as well too. It's funny to see the share of office shrink to virtually nothing in 2027.
Yeah, well, that's because so many of them are just short term. Maturities.
Yeah.
So just really quick going through some of this, Matt. Quarterly volume in terms of, are these loan origination volume or purchases?
I'm pretty sure that these are sales volumes.
So 25.4 billion. We're down 25.4 billion. That's a drop of 10% year over year in terms of price changing in terms of multifamily. So it's interesting. Now, cap rates, they're saying they have converged in terms of garden style and mid, high rise, kind of sort of urban and suburban, which is really interesting because we had a pretty wide gap between urban, suburban, garden, high rise for quite some time. And then, through the pandemic, especially in 2022, they really narrowed, which makes sense, as we've been talking about.
Yep.
The downtowns, CBDs have been weak, suburbs have been strong.
Mm-hmm.
I'd much rather have a suburban property than a downtown property.
Yeah.
And we've actually seen maybe even like a crossing of where suburban properties may be trading at a premium, which is really interesting. I mean, if you think about it, especially, the mid and high rise properties, you're usually getting better square footage, take as much acreage. But it's interesting. And for both, they have the cap rates, well above 5%, kind of coming in, right at, 5.15 or something like that,
Mm-hmm.
or, maybe, getting close to 5.25. National average, I think that's makes some sense with just the limited amount of pricing and market transactions that have occurred, and those that have occurred have mostly been, 1031 transactions where someone has been willing to kind of meet that strike price of that seller, or at least get close enough. So still relatively low cap rates relative to interest rates. That's where what we're going to continue to wait and see is as that 1031 money dries up. Because right now there's only a handful of deals that are coming on the market, handful of buyers that, have a big tax bill and they'd rather not pay the taxes, will take a lower return. But they'll get a point where there will be more properties coming on the market than there are 1031 buyers. And there's not going to be any more time to wait. A decision is going to have to be made. And that's where we could see some of the prices start to really decline, especially in the office market. I mean, decisions are going to have to be made. What are buyers going to do with these properties? They're either going to be handing them over to the bank, or selling them at just an incredible discount. And again, the entrepreneur in me is like, well, let's go buy some office buildings, but what are you going to do with them? I think you're right, Matt. Maybe data centers.
Yeah.
Let's figure that one out.
All right.
I don't know. I mean, or I'm like, do we buy a downtown skyscraper, move our offices to the top couple floors, and then just, room for activities below. And wait until the market turns around. I mean, like there's a price. There is a price. There's a price where that works.
Yeah.
Like it's low. It's very, very low. But like there's a price.
Space
entertainment venues. I don't know.
They're still not making more space, and but what they are making, all this knowledge work, all this information work, it's getting cheaper and cheaper. And physical space, it's cheap now, but it may not be quite so cheap in the future.
Yeah, exactly. I mean, and something when we get into the whole AI discussion and deflation and the effects of pricing and the economy and how that all affects real assets. I think, and you've mentioned that a couple of times in the last few reports, Matt, of technology still hasn't really created a new solution for a lot of real things that happen. Like housing. We're not all in the matrix yet, like in a pod.
Yeah,
like there, maybe one day, but not.
Things are happening in the real world.
Not over the time horizons of our investment and our business plans today. Matt, what else do you want to talk? I mean, we touched on Office. They have a piece on Office. We've kind of hit it over the head. Anything else you want to mention on this report? We've talked about retail.
Yeah, retail, office, and we just as a broad characterization, it is interesting to think about the situation that multifamily is in, and it wasn't in this report, but I was reading something this past week, and just kind of in the jumble of me gathering all this research, where it's multifamily is has one of the sharpest price mismatches of the sectors of real estate, and all of these office buildings. Yeah, people know, people kind of have a good idea where the office is at. It's not in a good place, but it's at least there's a direction there.
Yeah,
but there's a bigger question mark for multifamily. Considering, some places are getting a lot of supply coming online.
Yeah.
We don't know what the debt situation, how that's going to shake out. The fundamentals are still good, but the expenses are up. There's a lot of things that are in the air. Things are in the offing. Things are coming, but it's hard to get like an exact price, and that's why it's just so frothy. And I'm at a loss to know like what's going to hit first, and if there's going to be a slide, if it's just going to be this like staggered amount of opportunities, or if there's going to be a fundamental price change that happens, as we enter.
Yeah, because I've heard from a lot of syndicators, and I don't know if it's just we're raising money, and so we've got to have just all positivity all the time. But I've heard a lot of folks say of like, no, there's not going to be a price dip in multifamily. Like, let's just buy now and just keep going.
My gut says, almost like my pessimistic gut says, like, no, you're not going to get an opportunity. Everyone loves it.
Yeah, exactly. And so we're here. It's a great business. Like we're here, like we see all this data, but like you could have painted similar pictures back in the pandemic and no price drop really occurred, which means you have to be ready and on the data every single week and see where things are going. Because the one thing we do know, Matt, is we don't know where prices are going to go. Like, so we have to separate the investment case from the investor demand and like the underlying fundamentals of the business and the rental demand. And there's obviously a big correlation between the two. Yeah. Typically, when investor demand, the underlying thesis for like that thesis makes a lot of sense. There's obviously a lot of demand to invest in it. However, the mismatch is because of financing. It's a great business plan, but still the numbers don't make sense because the loans and where it's priced at. And real estate's a cash flow business, and so we got to get our cash flow. But we know that if interest rates do more normalizing than they have today, the value of those assets, really spikes back up in the near term. And I'm not like, it's not like many years down the road, it's like in the near future. But like today, if things have to be sold, the fundamentals say the prices need to be down here. And so who's willing to, make that top bid? Who's willing to speculate and go with lower cash flow for a few couple of years versus, folks like us that are saying, I want to buy on actuals, and like the price I want to pay today is going to throw off good cash flow today because I'm confident on the growth going forward, but I don't want to have to rely on that growth. I would rather that growth be like upside icing on the cake in buying for like in-place cash flow, something that I know is going to work, stress testing it. And that's good. Like it's easier said than done. And I've seen a lot. We've been talking about not using negative leverage for the last year, Matt.
Yep.
And that makes doing deals really tough. But we've done it. We've done it on 4 deals in the last year or so. Yeah, last year we've done it on 4 deals in this environment. Not a single deal negatively levered.
Yeah.
But then I hear other folks, other syndicators out there, other promoters basically saying, and I don't know if it was they heard us talking about not doing negative leverage, or basically saying like why we would do a deal with negative leverage. And it does make a lot of sense. It's very nuanced. It's more aggressive, but it's not wrong. It's just a different approach and a different risk profile.
Yeah,
that is leaning more into speculation and assumptions than actuals. And because, so like, let's say you're doing a value add, the rents are way below market. Let's say they're $600. Like you could do nothing and you can move them to $800. So you're going to buy that and the cap rate's going to look really low, but you're like, I know I can move it to $200. Once I do that, I'm going to have great cash flow. That makes sense. But going from point A to point B is not you close on the deal and you flip a knob and the rent goes up $200 and cash flow goes up. It's a long process.
Yeah.
It is a process. How long it takes is a variable. And again, how you financing it and how you're projecting things. Sure. Like, so you could buy a deal and say, and we can get cash flow up over the next couple of years, but what if it takes more than a year? What if it's 2 years? What if it's 3 years? What if something else goes wrong? Not saying that it will, but just, stuff happens and it takes a while to season a property. And there's more potential for missing expectations, I guess I would say. And so it's like a lot of sophisticated groups do that. That's what Blackstone does. They'll like, hey, if we don't care about, negative leverage or what the cap rate is, get so much money to place. Like we're focused on, and it's truly the difference on investors focused on total return or more of a preference for total return and focus for income or a balanced approach of where, look, cash flow is the lifeblood of this deal. I want to see a lot of like real cash flow, not pro forma cash flow at stabilization, maybe 2, 3, 4 years. And I don't know.
What you seem to be outlining is an outlook that I think is going to be crucial for the mental health of apartment investors over this hump of whatever distress comes, because what the projections are and what's happening right now is the values of apartment buildings are going down, but the income's not, so ignore those values, because if the income's going to be fine, then that will jump back because it's a product of the interest rate market and the investment market and all of that kind of things that aren't necessarily related to fundamentals. But you have to be kind of disciplined.
Yeah, you need to be disciplined. And I don't say you ignore the values, but they're not that on a deal that has fixed rate debt with some term on it. They aren't necessarily that important like today. Like you should have a good idea where the value is. Yeah. But like what matters is how much cash is it throwing off. But you want to know what the values are because that's how you can find some opportunities.
Yeah, well, and if we're talking about our own like reticence and distaste for negative leverage.
If you're not going to sell for 5 years or 10 years, what the price is today versus has nothing to do on the total return of the asset. It only matters when really a capital event happens. And so if values are today versus where they are next year and 5 years from now, it matters when you refinance or it matters when you sell.
Yeah.
And you transact. It always matters, but it doesn't really affect total return.
Yeah.
And you could say, you want to be careful of not putting your head in the sand and being like, no, the value hasn't moved. It's worth exactly what I paid for it. Because that's just not reality. But does it matter? Like, because it's not being traded on every day. That's, I think, up to debate. And that's a great thing about real estate. It's like we have deals that it's worth less this year than it was last year. Other deals that are worth way more, especially as we bought them a couple of years ago. So they're worth way more still today. Even deals we bought last year, since we boosted NOI, they're worth more. But like we're not selling next year. So, and it always takes, in my experience of doing this, thousands of units, it takes 1 to 3 years to like fully season a property. You can do a lot in a year, you can do a lot in 6 months, but it really, in my experience, it takes 3 years.
Yeah.
So the first couple of years, while they're incredibly important and time is money, not unless I look at the value every month, maybe every quarter.
Yeah, well, and that's what I mean. It's like if you're eyeing an exit, whether it's demand for your investors or you see, that this is your path, and so your strategy from the beginning, then great, look at the value. But what I'm saying is that we could be in a situation where NOI is going up and valuations are going down.
100, oh yeah, exactly. They are.
And like that's important if you're going to exit. But otherwise, like if you have a long enough horizon, you could look at buying opportunities instead.
Yeah, exactly. And that's what we're doing right now.
Yeah.
It's like all of our deals are set up for the long term. We don't have to do anything right now. So we're setting that aside, being smart on asset management and keeping moving forward and fine tuning and reducing expenses. But it leaves us now open to say there's going to be some potential great opportunities.
Yeah.
And if there's not, that means all the rest of our portfolio is still worth more than what we thought it could be.
Yeah.
Again, does that really matter if we're not selling this year? No, but that may mean that we have refinance opportunities next year that we aren't thinking about right now. And so if you have different durations, if you have long-term holds, you have so many opportunities if you set them up the deals the right way to, refinance instead of sell, pull some cash out. I mean, we're doing a property right now that we've owned now going on 6 years. 5-6 years. We're looking at refinance. It'll be the second time we've refinanced it, and the second time we've pulled more than 100% of capital out tax-free.
That's nice.
Yeah.
That's nice.
130% the first time. We're going to do this next one is going to be almost like 150, 170%. So everyone's gotten their money back. It'll be while we still own the deal, it'll be over a 2x. It'll be like a 2.4x, but we still own the property. That means we can refinance it another couple of years again when rates are actually even lower. Or we can sell it at some point, but like right now, it's throwing out so much cash. Why would we sell it?
Yeah,
we could just continue to pull cash out of it. So like, but if you have that long-term horizon and you've structured it that way, you have so many more opportunities.
Yeah.
If the prices like skyrocket, you can still refinance and sell. There may be a prepayment penalty, but again, that's like the insurance that you're paying, for that long-term horizon.
Yeah.
And sometimes that prevents you from taking action, but if the gap is wide enough, you can usually make sense of it.
Yeah.
Or you can get a supplemental on your loan. You don't have to pay the prepayment penalty. There's a lot of options. That's why multifamily is great, and it's a good position to be in unless you had a short-term approach, an aggressive approach.
Yeah.
And you bought with negative leverage because you were like, well, we're doing a value add plan. We're just going to grow out of it. And then you don't get your premiums and your expenses go up.
Yeah.
And you did a bridge loan because you're going to do a value add. And, then you're still negatively levered. You haven't grown yourself out of it. So like it's not a put a bookend on the negative leverage.
Yeah.
But it's not bad. It's not a wrong strategy. It's very sophisticated. It's what some of the best, largest firms in the world do. It's just a different risk profile than going off of actuals.
Yeah, well, and that's what I was gonna say. It's like it is a risk. They took that risk.
Yeah,
and a lot of people are getting the wrong side of it right now.
But I'm seeing it more come back today of people like looking for. Everyone's hungry for a deal. Everyone wants someone to do a deal. Everyone needs these deal fees, these acquisition fees, the scaring, all the stuff that often keeps the lights on. Especially if you don't have a big portfolio with recurring revenue. And they need a deal, and the only deals that are even an option, they're all negatively levered.
Yeah.
And so they're basically saying like, no, we know this, and like, but like if there's a reason behind it and we're good at it, and again, go for it. It's just it's a different approach from what like we do.
Yep.
And if you look at our track record relative to a lot of other groups, our returns are better or the same. And so maybe we do less deals. But I think that there's the risk-adjusted return.
Yeah,
I think we're the beneficiaries of.
Yeah,
Again, not enough to invest and not really just pushing what we do, but just exploring the mentalities of those in the market, and for those that are investors, what to just be aware of, and that more aggressive stance may be attractive to you. I like the standpoint of being like tight and aggressive, like you're playing poker. Like it's got to be you only really move when you have like the right hand and the table's right. And then when you move, you move very aggressively.
Yeah.
but you're not betting in on each hand. You're not just betting. I mean, you have to play the game. You have to participate. But if you're just doing just every deal, like you end up losing quite a more frequently.
Yep.
And you don't go as hard on the ones you really should.
Yep.
And so it takes a little more work to generate the ones that you go hard on, but it's worth it at the end of the day.
Mm-hmm.
So I don't know. I've detracted from our.
No, I think that's right. I think it covers a lot of the ground, a lot of the discussion that is in this kind of second segment of
Let's talk about it.
the show.
Globe Street's got some pieces for us, Matt. Why don't you just
totally
us through?
This is a subject that we're just talking about, and we're going to keep talking about it because it's important. It's a trio of articles from Globe Street, maybe one from Gallup, that all orbit this planet-sized issue of commercial real estate and debt, and show really how much the attention has ratcheted up on the topic of loan distress. This kind of stuff that we're talking about. And one of the related or included issues is this idea that banks are getting tighter, and there's a little bit less, maybe a lot bit less activity when it comes to these CMBSs. And this CRE index has a 33% drop. Banks had the largest share of non-agency loan closings for 4 consecutive quarters, but they have fallen 33% in the first quarter from the fourth quarter of last year, and 53.5% from a year early. Borrowers are opting for short-term fixed rate debt with shortened call protection until volatility begins to normalize. And I think that's kind of interesting. The Mortgage Bankers Association reported similar trends for the first quarter, with originations dropping 42% below, not just 33, but 42, and then 56 down from the previous year. I think that this is a symptom of a this larger, more volatile market. Yeah. I think that it is also, it's hard not to imagine the idea that banks are getting stricter too. Maybe the activity's gone, but maybe they're also getting
definitely a spotlight. I mean, the tightening is a real thing.
Yeah.
I mean, you don't have all these potential real bank failures, potential failures, and volatility. Even though it seems like maybe that's sort of water under the bridge, I don't think it is.
So banks getting stricter, NOI and valuations. I mean, you got interest rates too. These are all like kind of independent factors that are really over determining this situation. It is going to involve some kind of action.
Investors, see what happens. And equity investors, definitely feeling more cautious.
You brought up this Warren Buffett, which I do have words.
Yeah,
but in the following article, I want to mention, it seems like it maybe a market is growing related to loan distress that hasn't been I just think it's interesting how the market's going to evolve to meet this need of these distressed people.
Agreed. So Warren Buffett, it's time for CRE borrowers to feel the pain. Is he? It's interesting, because Berkshire Hathaway owns commercial real estate company called Berkadia. We work with a lot of those folks. So it's interesting because, and I don't know, he's invested in so many different sectors in the economy. Now, Berkadia is mostly multifamily though, so it's not necessarily office, although they probably do some office stuff. I don't really know, to be honest. Just did another multifamily world. Mm-hmm. But so what's the Oracle from Omaha say?
I love the intro to the article. The legendary investor from Omaha who gets a burger for lunch every day at the local 5 and Dime.
Well, yep. Okay. All right.
I thought so when I did this article, I was going to have a lot of facts about Warren Buffett, about how frugal he is. Warren Buffett, who drives a 1987 Honda Accord to work every day, but he doesn't drive that. I really thought that he drove like a beater car. But
does he drive?
He drives a 2014 Cadillac, like CTS, which isn't like a Lotus, but it's it's not so bad.
Yeah.
So
it's like not. I mean, that's like a classic. I mean, I don't know. I mean,
he's reasonable. He's a reasonable guy.
86, 87.
Yeah.
So that sounds like what an 80.
Totally.
80s. Yeah. Does he even drive? Not just from he's a billionaire, but like he's also getting older too.
Yeah. And that's the thing is like you get these. I will click on the Warren Buffett article. And it's like clickbait, and you want to know what he thinks, and he's not wrong. He's saying that people entered under the wrong assumptions. They thought that interest rates would stay low, and they didn't. They entered like what we said. these people entered into bridge loans or floating rate debt loans a couple years ago when rates were low, and now they're going high, and it's triggering increase in their payments, and they should be able to pay the piper. I don't.
Yeah, that's how it works.
Yeah,
That's how the market works.
It's kind of. I haven't really heard any whispering of, or really even speculation about CRE related bailouts. I don't. That's not like in the cards in terms of like people's imagination of the market, but I don't know if this is trying to like.
No, we should not
head it off.
No.
I don't think we should.
Okay,
but it could
it's
be,
like
it will be talked about.
Sure, yeah. Anything could be too big to fail, but I mean, like, look at the office again. Like, we need this. It has to be fleshed out. There's no use for it.
Yeah,
the prices have to go down to zero so they can be reused.
Yeah,
if the prices stay where they are, we can't make the market can't do what it does and find new uses and life for all of this stuff. And if it gets propped up, we're gonna have ghosts, shells just sitting around, zombie buildings. Yeah, and there. But could that happen? 100%. 100%. If people scream loud enough, it would be just disastrous.
That's a good point, though. It is like a creative destruction, because if they get bailed out, they may just sit empty. It may not get used.
Exactly.
And this is what I was going to say too. It's like, it's funny that Warren Buffett's saying it's time for CRE borrowers to feel pain, but a lot of CRE investors are waiting for the same pain that Buffett is describing. They want to buy up those assets and use them. It's called distress. It's not called comfort.
Yeah, no, it's got to let the cycle play itself out.
But it is an important reminder, and it's like I said earlier, if there is a distress, especially in the multifamily industry, that means that prices go down. That means that the properties that you hold, their prices will go down too. You just have to have, you have to kind of understand the long-term nature of, and not be in a position, you don't panic and sell, because that would be a mistake.
Yeah, no, I mean, you have to be ready for the ride. I mean, investing in anything, but these are incredible, volatile times, and
we will
you need to have, if you were convicted that it was like the right move, and you have some time horizon, you're in a good spot. If if the deal's set up the right way, you just need to keep calm and carry on
and ignore the headlines that are there. You're going to see headlines of apartment prices plunge. Yeah. Is this the end?
Let's take it day by day.
Yeah.
Focus on the blocking and tackling and the operations and the revenue up and the expenses down and working on the bottom line. And because I guarantee that if you're doing everything from an operational standpoint, even if you are in a bad position with a lender, if the conversation is the property is, operating exceptionally well, it's just, we're just in this pickle because we can't refinance, that lender is going to be much more open to working with you, especially if you have the relationship and you've been communicating, rather than a property that's been neglected and ignored and mismanaged. Like, maybe the bank doesn't want to take that over because it's a headache, but why are they going to give you like a second chance?
Yeah,
I don't know. Maybe some people are going to run them into the ground because make it so this takes for the bank to take over.
Yeah,
that's why. I mean, what we're doing right now is talking with lenders and banks and being on that call list, because whether it's from a management perspective or from a, hey, we've got this deal, we need a fire sale, you want to buy it?
Yeah,
we want to be that call. Say yes, or ready to go. It's a great asset.
Yeah,
or not. Just moving on. Just because we're knocking out the street pieces. Totally. Can these recent private equity deals actually save commercial real estate? What are they talking about now? What private equity deals are they talking about?
So
Warren Buffett's name showing up like once again.
It's some of these deals that are like, it's like, there are some like rescuing or providing capital for lending,
regional
and
meetings.
What I think it's kind of describing is this is this emerging market, really, and it's not like being born right now. It's just growing market to address the loan distress or the financial requirements for some of these for some of these borrowers. So let's say someone's facing some hard times. They've got an apartment building that they need more cash from. They can ask their investors, or they can get like mezzanine debt, or they can go. There are like all these
rescue capital. There's different buckets of money,
and it's like, and what seems to be, it's like, and the subtitle is like, well, some of the rescuers also need to be saved. Well, yeah, that's just called risk.
Probably, yeah. The same debt funds that are like, we're going to, throw out some mezzanine and debt and all this creative financing are oftentimes the same ones that were issuing a lot of that stuff in the first place.
And it's like there's a risk anyways. If you're an equity investor, there's a risk. And now what we're having is like with mezzanine debt and with all these different categories,
there's always risk.
There's always risk, and now maybe there's just a wider,
especially on the debt side where it's like the delinquency defaults are near 0%, and now they are ticking up, and debt investors aren't usually used to that type of nervous situation. It's gonna be interesting, because the other thing to keep in mind is that this rescue, people are like, oh, there's gonna be some rescue capital. It ain't gonna be free.
Yeah,
and there will be strings attached, like many strings. It's not necessarily gonna be like a easy pill to swallow. It's gonna be very large and very jagged and dry, no water.
Can you share? Because this is just a general impression. It is a dry mouth. It is a general impression that like there's a market for more options of risk. Yeah. Maybe
if for the right deal, it'll be the right group.
Can you outline some, whether it's mezzanine debt or preferred equity, or just kind of the spectrum of like least risk maybe to more risky?
Yeah, well, and this gets into another conversation on the moving around in like the risk spectrum, and where a lot of equity investors, especially on the JV side, have moved down to preferred equity, and it makes a lot of sense. And you also see the pref equity folks moving down to mezzanine debt.
Okay, and
there's a kind of really good reasons. One, you're getting a higher coupon, especially today. But if you're an equity investor, let's say you're a JV equity group and you've been doing deals, and they've the total returns are in the low teens to mid-teens. Like the best you've seen in the last year is like a 15% IRR, but a lot of the deals have been 12 to 13%. Very little, if any, cash flow. There's obviously risk in that, as we've described. But if you come in as a preferred equity, and what preferred equity is that after you've paid all of your expenses, you put some reserves in your bank account, and you've paid your mortgage, the next group to be paid would be preferred equity, if there is preferred equity. Sometimes there's just one group of equity, the investors, the LPs, they get paid next. But if there's preferred equity, or what could even be before that would be a mezzanine loan. Okay. It's all talking about the order of who gets paid.
Got it.
And so you pay your mortgage, and then let's say
that's maybe the least risky.
That's the least risky. So you're in first position. You have the first position if something goes wrong. I am the first position, to that deed. Yeah. I can come in and cure whatever that I can at least try to force a cure, in that may mean foreclose on the property.
Okay.
Now, in the next position, if there's mezzanine debt, would be like a mezzanine lender. Maybe it's the same group as the your first mortgage. Maybe it's a different one. But typically the terms will be different, and the interest you're going to pay is going to be much higher because there's higher risk. So if your first mortgage is, call it 5% today, that mezzanine may be like, I've seen some mezz quoted up to like in the low teens to mid-teens. Whoa. For equity, is a little bit different. It's technically not debt, but there is some preferred equity that can have certain rights to, if you fail to pay, there are some covenants where they can act like debt and take control of a property in some cases. Other preferred equity, it's just you're getting paid after, whether it's the first mortgage, and if there's a mezzanine loan, if there is a mezzanine loan, you're the next one to get paid before the common equity. But your return is typically capped. So usually you're getting like a preferred return anywhere from, call it 10 to 15%. Some of that may be like a current pay. So like, for example, let's say that you had a let's say the rate of 15%, and 7.5 was current pay. So they're going to pay at 7.5%. And then another 7.5 would accrue, would be paid at a later date.
Okay.
And there's typically a term, they need to be taken out over 5-year period. So there's more risk associated with that because there's strings attached. You're paying a higher coupon rate, but they're not necessarily taking a huge chunk of the equity. That was long-winded, but the advantage of the equity investor, if you're going to get 12 to 15% on pref equity, that is less risky and a higher prioritization of cash flow, that seems much more attractive than being the last to get paid in common equity, where the total returns are projected only to be less than the total returns of the preferred equity. Now you have but what you have in the common equity you don't have in pref equity is a somewhat uncapped, usually uncapped upside.
Okay.
So once the deal sells, those pref equity investors, they get they're made current, they're 12, 15%, whatever. They're done. The rest of the cash flow flows to the common equity, just split with the GP. Yeah. But if the deal just hits an absolute home run, and you get a 5x. Well, that common equity investor is going to have a total return way above anyone else. But if it's just an average deal, the pref equity investor may come out ahead, but again, they're taking less risk, less potential return, but they're like, well, okay, we're going to get 12%. We'll do that all day long.
Man, I like the idea of a debt souffle or like a sundae.
Yeah.
Parfait.
It's a layer, parfait. Yeah. I think parfait is more accurate because it's different kinds, there's different flavors. I like
very interesting.
The ice cream, I guess, would be the first position.
That's right.
Equity would be like the nuts and cherry on top. Common equity. Yeah. No, that's good. Matt, let's keep pushing. Ready
yeah, for sure. Let's move into. So there is this Gallup article that I think flows from this discussion that we're having about interest rates and about debt, and it's a really short one, but it just
man, so sick of talking about interest rates and debt.
I know.
There's so many different angles to
take. And this is just one of the effects of it, which is that that real estate's lead as it used to be seen as the best investment. It's still seen as the best investment, but it's shrinking a little. I think it's completely understandable.
Opinion? It is. These are surveys?
These are opinions of the average American. And I think that it is no surprise that the opinions of Americans are that real estate investing is less favorable than it used to be. Interest rates are, I would argue, the most visible as mortgage rates. And I think that gets part of the way, if not most of the way, to explaining this take. I think that when people think of investing in real estate, they are thinking of home flipping. That is at least that's the average American's most visible. Maybe they're thinking of office buildings secondly.
Yeah.
And that is not, those aren't doing too great. So
to me, this is a good opportunity because, we're seeing, even with high interest rates, we're seeing strong demand for housing. But if the sentiment is going the other way, that means less bidders. That means, again, the fundamentals are really strong, but not as many bidders, better price.
Yeah.
And it's still, the real estate is still the most favored investment according, to Gallup. It's interesting. A lot of foreign countries have really been stockpiling gold as well. I know China and India have been really increasing their purchase of gold. It makes sense. In an inflationary period, typically, gold is a hedge against inflation.
Yeah.
It hasn't played that way as true to form this cycle around, but things could be delayed. And certainly, again, this is sentiment, but that opinion is definitely there. It'll be interesting because the public's opinion of the economy is pretty lagging. It's pretty delayed.
That's what I think. This is a little bit lagging because, especially because the home sentiment has ticked up a little bit in some of the more frequent surveys from places like Fannie Mae. But it's not. People are still. I think the majority. If there was a majority of people would say it's not a great time to buy a home.
Yeah.
But if you break it down, it makes sense that, due to interest rates, I don't think people are thinking about two-year floating debt situations. They're thinking about, and the expenses are rising. The cost of stuff is higher.
Yeah.
Who wants to buy a home in these situations under these interest rates?
Yeah. Agreed. Okay, Matt, let's talk about AI.
Oh, good.
Yeah. And I'm glad we're talking about it because, as you know, we have been doing a lot of work with AI here at Great Capital. I don't know if I haven't shared this with you today, Matt, but I generated a really cool blog post using ChatGPT yesterday. Can I share it live on the show? While I pull it up, bring us into this BizNow piece.
A couple of BizNow articles exploring the potential of tools like ChatGPT to maybe revolutionize the real estate industry. I think that for me, it's important to temper expectations. And this is going to be my take on this. I think I'm getting a far better understanding of how to use these tools after learning what they are not good at, rather than learning what they can or could do. Ask any excited AI evangelist or AI doomer; those aren't mutually exclusive, and you'll hear that this technology can do anything, will change everything, and is being implemented right now to drastically improve productivity across industries, from healthcare to urban planning, from legislation to sanitation. It will do everything, but that's all well and good. But you don't learn anything without jumping into it and kind of wrestling with the AI and realizing, oh, I shouldn't be asking it this kind of thing. I should use my own brain and to recognize the shortcomings is to recognize where humans can jump into this and actually use it and contribute.
It is a blunt tool, especially without really knowing how to use it and what you're trying to accomplish and what you need to feed it and the inputs to get the outputs.
Yeah.
Because I've been using ChatGPT and now Google Bard a lot over the last 2 months or so, and I have made practical uses of it, especially now the ChatGPT has more plugins that you can use. It's connected to the internet, but it is not perfect, and certainly what it does not produce finished products. It is a great tool to start something. For example, when we're putting together a new investment committee, I'm exploring ideas on bylaws and structures and formations. It's a great tool to help kind of explore different ideas, and they can really accelerate a lot of busy work. And it can help on research, it can help on rewording things, but you have to be very specific. And so I just pulled up this, let me see if this works. All right, Matt. So, I've just been like experimenting, and I have these web plugins now. And so I started this whole piece with basically like pop in the Redfin database, give me information. It's pulling out, homes for sale. It's not really what I wanted. It couldn't give me the rent growth information. And then I was getting frustrated because I was like, give me just use all of your resources and the best of your ability to find any information regarding rent growth in Indianapolis. It's like, I know you know this. If you can search the internet, if you're like, you can have this. And then because I had asked it before, try the internet.
I know.
I'm like, it couldn't find the information. I said, what is the most recent rent growth data for Indianapolis? And we use Wolfram Alpha, the plugin. Couldn't find the information. Try Redfin. Couldn't find it. Try the internet. And then it's like, I can't find the specific information. And I'm like, okay, I obviously haven't been specific enough. And then I said, use all your resources. Again, this is like if you run into a dead end, but then there's a different way to word the prompt. So I use all of your resources, the best of your ability to find any information regarding rent growth in Indianapolis. And lo and behold, it's like, oh yeah, we know we have rent growth information, but then it didn't tell me what it was. So I was like, what is current rent growth in Indianapolis? Finally, it brought me the answers. Then I was like, rate Midwest market for apartment investing, list reasons for ranking and cite data, use all plugins, prioritize using the web. When using the web, search multiple sources, do all to the best of your ability and use all resources. It just kept chugging on this one because I think it's because I told it to use multiple sources and do all of your best ability and use all resources, which I think that does something. I wanted to make sure it uses all the plugins. And it wasn't using the web. It was going on Redfin. It wasn't finding something. It wouldn't continue to search. So I have to remind it, you have to keep looking. And so this is how many web queries it went through. And then it stopped. I said, regenerate last. Use different sources such as Yardi and apartment lists. Because I was like, let's give it a little bit of help.
There we go.
Bam, here we go. Columbus, Ohio, Indianapolis, Cleveland, Detroit. I thought that was interesting. And it gave the information. This is based on Yardi apartment list, which I told you use Ann's number. Columbus is number 1. Indianapolis number 2. Give us some data. Talk about rent growth, average rent, occupancy. Then Cleveland, which I thought was interesting, and Detroit, which I thought was interesting. Those wouldn't be my 3 and 4, but very interesting. And then it tells you to think about other factors. And then I was like, okay, let's take this one step further. And I told her to write a 3,000-word PhD level white paper on investing opportunities in suburban Midwestern markets. Told her to do some case studies, and then it's like, I can't do that. I'm like, okay, now 3,000 words. Just write the PhD level white paper. Use your plugins, best of your ability, cite sources. Also generate general investment theses for investing in large multifamily apartments. I wanted them to throw that in because you have to kind of tell it where to go. You can't assume it knows what you want it to do. It's a tool. And so it threw out this nice, although I thought brief and not as detailed as I would like, little white paper about, the Midwest, general investment thesis for large multifamily apartments, some case studies, which I thought were very solid. It cited the sources and footnotes, which wouldn't be the style that I would use, but that's, I guess, more of the PhD level white paper style. Conclusion, how is nice for references that I can link to.
I do like how they're using the three markets that are measured with three different organizations for rent growth.
Exactly. Exactly. So it's like, okay, I have this, but then you have to take, this is not publishable at all. When you have to review it, it's not apples to apples, then it's like we would have to swap out all the data.
Yeah.
Or I could just tell it.
Rewrite.
I could just say, regenerate this, rewrite it, only use the same sources, and it would do it. So then I was like, more data, longer length, explore advantage of investing in the Midwest over the Sun Belt and other regions, then I was giving it more of a direction. I was like, I want you to distinguish the Midwest from other markets, and then why we like it. Suggest the Midwest have been overlooked and mispriced, and then so it did a bunch of research on its own.
This is important, I think, for people to kind of understand how people, because a lot of the discussion of how to use these tools is like, yeah, I just did this, and then like, look what it did.
Yeah.
But like, no, you argued with it. Anyone, the best stuff that I've seen is like, you got to argue with it for a little while. You got to say, no, do it this way, or talk with it.
Yeah.
But it's never just a one and done.
No, it's not. No, not at all. So it outputted this I thought it was a really good step in the right direction. It talked about, the Midwest real estate market. It talked about Indianapolis, Lansing, and Columbus were three markets that I had wanted to talk about. Gave us some facts, advantages of investing in the Midwest, which I think it hit really nail on the head. Obviously, I influenced it. But it started, pulling out, some risks in like the Sun Belt that like I didn't tell it about.
Yeah.
Including, the Sun Belt region has seen a significant increase in property prices. I didn't tell it that, which could potentially lead to lower yields for investors. Something I said, but I didn't tell it that. Additionally, the Sun Belt is more susceptible to natural disasters like hurricanes, which could lead to higher insurance costs and potential property damage. True, but I didn't.
Yeah.
It figured that out for me. Nice conclusion. I told it great, now longer and better. So, and then when I did that, I was like, that's a bad prompt.
Well,
like you need to be specific, but I wanted it longer and better, and I wanted to see what would happen. And it made it a little bit longer, especially the general investment thesis for multifamily. It made it a little bit bigger, not much more. And now I was like, okay, so we've got all the data, and no one wants to read a white paper. Convert it to a blog post. Include the data. Use a click-inducing headline. So this is the click-inducing headline, Matt, which I don't really then love, but unearth potential. Why the Midwest is the next big thing in multifamily real estate investment.
Unearthed.
Yeah, unearthed. I was like, interesting. The Midwest Advantage goes through case studies. It goes into much more qualitative information about the markets than just data. Then it reverted back to like using citations as opposed to putting the data in the body paragraphs.
Yeah,
which I like.
Cites them in there. It says according to, and then it has.
Yeah. But sometimes it's like I would like to know what maybe this.
I want the actual number.
I want to know what the actual number is. So the good case study, Midwest versus Sun Belt. Conclusion. The Midwest Advantage, but then it just like started repeating itself.
Yeah, that's what. No, I that's like, exactly what happened.
And it got itself into a loop. It just kept going and going and going and going. So I was like, stop.
So I tried to have it help me write the notes for this podcast and try to get articles. Did not have a lot of success with it. It kept suggesting the same article from like a bunch of different sources. It was like this minor multifamily acquisition. I was like, nope, you can stop. You're okay. And there was one I was telling you yesterday. I was using Google Bar, and I was like, well, okay, give me some articles. Do you know what the Gray Report is? Yes.
Yeah.
And then I was like, okay, so can you give me 20 articles that would fit in the Gray Report? And these multifamily articles, and it had like 20 or 12 believable articles. Let's do it right now. This will be funny.
Okay. Can I finish? Yeah.
I'm sorry.
No, you're good because I
didn't know that you had this final draft. I stopped at the unearthed potential.
No, that we were getting close. I wanted. Sorry, and this is going on too long. But I told it to them once we had that. I wanted to write in the context of the Great Capital LLC blog and content on the Great Capital LLC YouTube channel.
Oh, okay.
And then so it took like I don't know if our transcripts. It looked at our blogs. And it changed it a little bit, and so all of a sudden it's like Indianapolis, the heart of the Midwest. It gave it these nice titles, and then it also talked about at Great Capital C. It took a lot of the verbiage that we use. So I thought that was interesting, and that's And then I made some other tweaks, so I thought it was a useful tool, and I was like, this. I got it to a point of where with some additional editing, I was like, this is useful. I can publish this. So Matt, what?
I'm going to recreate this whole thing. We'll do it live, just in a new tab.
It's a new chat.
In a new tab with Google Bard.
With Bard?
Yeah. Because Bard is funnier to me. It makes more mistakes.
I've gotten Bard to do things I can't get ChatGPT to do, and ChatGPT to do things that Bard can't do. And I've been using the same prompts in different AI generators. Google will give up a little quicker.
Yeah,
I asked it to do something, and then it was like, I can't do that. I asked it to analyze some things, like I can't do that.
Yeah,
and I said, write a blog post analyzing it, and it did it.
It's interesting.
It's like I'm a language model. I won't do that for you.
Yeah.
Like, okay, write about it. Obviously, that's what I want you to do.
And there is, they talk a lot about hallucinations. There is like a level of confidence and like objectivity that these AI tools use that you need to get into situations where they're wrong so that you understand, okay, it's going to be it'll lie to you right to your face, and it doesn't see it as a lie.
And that's what's scary, because like as a business owner, part of me is like, oh, we got to get this in the hands of all of our team. This is going to make everyone so much more productive. People are saying it'll make everyone 30% more productive, but you have to have a lot of like rules, because all of a sudden the fear is people are just going to be using this to generate emails or posts and things they don't review, and it's just a bunch of garbage, and it's wrong. And so like it can be a slippery slope either way, really. And I think that's why we have to be smart about how we use it and refine some of the use cases and exactly how we're going to use it in the steps and the processes and in like the checklists. Like there's a lot of potential, but there's a lot of pitfalls. And it's like, so often it's like, okay, that's like 70% of the way there. Yeah. But it's not.
Exactly. And that's what I mean is if you want to really use these tools the best way, you need to figure out where the shortcomings, put yourself in there to compensate for those shortcomings, and then ride that wave, because those shortcomings are going to be different as you go different. So I'm going to try and ask 3 questions.
Okay. Ask.
It's going to be really quick. Okay. So first question is, do you know?
This is all caps. No. Does it know you're yelling at it?
Oh yeah. I'm sorry.
No. Yeah. No, I think sometimes I'm like, no, I have found myself getting a little edgy sometimes when it's not what I wanted it to do.
Yeah. I know. You're arguing with it.
And then, okay, but I don't want to be mean to it.
Oh, this is another thing that before I do this, and this is my important part too, is I think everyone's paying a lot of right attention to this, and it's a lot different. And a lot of people are, jumping on the hype bandwagon. They're repainting over everything that said NFT and crypto, and now they're just putting AI. But I do think that it is important. I think that one thing that is different about AI than all these others, even really social media or the internet, is we've been talking about computers as brains since like the 1950s. Ever since computers were invented, we conceived of them as these, it's just a way like anthropization or whatever, anthropomorphism. And so we have this imagination. We've been kind of meditating this, whether it's Westworld or like Lost in Space. We've been meditating on this topic for a long time.
Well, they had all the. I mean, Star Trek had all this. They had the computer. You could give it a complex problem. It could figure it out. I mean, not to mention data.
And so I think that I don't think we're jumping the gun. I think that it is doing amazing things and it will do amazing things, but I don't think that we're completely caught off guard with it. I think that culturally we have some sense of where.
Oh yeah, and we all know where it's going to go. It's called the Matrix, and
exactly.
We've seen the Terminator. It's
so at least
so one. Yeah. So okay. So Matt, hit enter. Everyone.
Do you know about the Gray Report podcast and YouTube series? And so I'm asking Bard this. It says I'm a text-based. Well, that was different than that was.
But it's like, okay, you connect to the internet, you can't search. Right, ask it to write a blog post about the Gray Report podcast, and I often say on the Gray Capital LLC YouTube channel, but I don't know.
Well, I just wanted to say, give me 5 articles on multifamily investing published in the last 2 weeks. Bard is connected to the internet, and when I ask
Fit to write a blog.
Write a blog about
and tell it to cite its sources and tell it to use all of its available resources.
Using sources published within the last 2 weeks.
Tell it to use the internet and use all of its available resources. in my mind, it's utilizing all of Google. It's like it's getting into all of their servers and it's going to answer this question. Maybe it's just
and cite sources.
You have to say to your best of your ability too, because
crap.
you don't want it to just Okay,
right, I'm gonna give up.
Okay,
but I do just want to share my experience with it yesterday. I was able to get something out of it. I said, "Do you know what great capital is?" I said, "Yes." I said, "Okay, so can you give me 5 articles for the Great Capital podcast?" And it gave me 5 articles, and then I was like, "All right, tell me when they were published. Just tell me when they're published." So I Googled these articles, and the articles aren't real. They made.
Sometimes you have to prep it.
Oh yeah.
Sometimes you have to be like, "Do you know what this is?" And then it knows what we are. Okay. So again, this is a handful of times. I'm like, man, I got the answers. You're like, I did the same thing. It didn't work.
You have to back them into a corner.
You have to back it into the corner and show it has the information.
Yeah.
Do you have access to the Gray Capital LLC blog? So now it's going to go through and look at all of our blogs. It's going to get all the ideas of articles. It's going to scan all that. Yep. Here's some last posts from the Great Capital blog. So now we're going to ask it the same thing. Now, I think if I would do this, I would say in context of
So do that. Yeah.
But let's just see if it does it now that we've helped it out a little bit. Oh, it suggests it's suggesting these are 5.
Yeah.
So again, it's I didn't understand what I want to say. One thing I want to show, I know we're talking about this a lot, but I think there are a lot of really cool use cases. So for one, I started telling it, and this probably isn't the best thing to do. I started telling some things about our company, about Great Capital as a business consultant, and I told to ask me as many questions as possible for it to help me.
Yeah.
And it was pumping out some really good ideas. I even provided some rough numbers. On our budget, and it was able to give me some really interesting information. But then I set up. I was emailing through here, but I started loading in, Matt, a bunch of PDFs in articles from the last week's Gray Report episode, and. It's just a lot of PDFs, the NAR report, the RD report, BizNow articles. I loaded a whole Gray Report episode up. And now this conversation has the entire knowledge of all those articles, those reports. And I was asking questions. And I even asked it, and this is interesting. I asked to describe the average viewer of the Gray Report show on the Gray Capital LLC YouTube channel. Who is the avatar? Why are they watching? Why do they return? And it didn't really know. So here's the difference where Google Bar did a better job. If it spits out the same. So it actually gave me, and it's funny, this is different from what it spat out yesterday because it had 40 to 50 on the age. But it looked at, it talked about what the show is, the typical demographics, the age between 45 and 65. They have a significant amount of disposable income. They're watching the show to learn about the latest trends in multifamily investing, to get advice from experts, and network with other investors. They return to the show because they find it to be informative and entertaining, and they appreciate the insights that the hosts provide. Appreciate that, Bard. They would like to see more content. And I asked, I was like, what do they want to see? They would like to see more content on the show that focuses on specific strategies for multifamily investing, as well as more interviews with experts in the field. They want more interviews.
We can do that. We like that too.
Yeah. And then it told me their income is 200,000 plus. They're a business owner, executive or professional. They're interested in multifamily investing, real estate finance, their goals, some reasons why they return. This was I thought this was great. And ChatGPT couldn't figure it out.
Yeah.
But I can ask ChatGPT now that it has all this information from the Gray Report. I was asking, given the information and data provided, suggest an acquisition strategy tailored for today's market, and focus on high demand markets. Consider emerging markets, and that gives you examples of markets to consider in both these categories. Invest in affordable housing, long-term holds in stable markets, and leverage data and technology. Diversify your portfolio, build strong relationships. All things that make sense. I would say maybe a little
these are bold. They're not saying anything.
That's nothing really new. It's not. You're not going to get anything groundbreaking.
Yeah,
but you are going to get some real analysis.
Yeah.
And it's got all this data in here from these PDFs.
Yeah.
And so you can really use it to ask, here, let's just try, summarize the current state of the multifamily market in less than 500 words. Use all data inputted. Do the task to the best of your ability and use all available resources. I know I misspelled a lot of things. I wasn't looking. It's going to figure it out. It's got spell check. Headline: Multifamily market. Navigating the current landscape, the multifamily market, a key player in the real estate industry, is currently experiencing a myriad of shifting dynamics as we journey into the second quarter of 2023. This summary synthesizes insights from various authoritative sources, with particular focus on the Yardi Matrix Multifamily National Report, supplemented by insights from CoStar Group and the National Association of Realtors. The Yardi Matrix Multifamily National Report identifies the top 10 markets in the U.S. that have witnessed the strongest rental demand in the terms of rent growth, absorption, and lease new supply relative to inventory. And I kind of told it to look at that earlier, so maybe it's getting some influence. These markets include Phoenix, Vegas, Sacramento, Riverside, Atlanta, Tampa, Charlotte, San Diego. Interestingly, the Midwest, U.S., particularly cities like Peoria, Indianapolis, and Omaha, and Lincoln have also shown strong rent growth. However, the multifamily sector is not immune to broader economic trends. I'm not going to read this whole thing, but it's doing a really good job, Matt. Because once you get it, once you give it all the data, it's less elusive. It has actually like concrete data to go off of and build upon.
Want some citations and to follow up on some of the conclusions, but
and in the next version, I can just tell it to use citations.
Yeah.
So,
but yeah, the story that I had was I asked Bard at the time. I asked it yesterday. I forget how I phrased it, but it said, "Yeah, I know about Gray Report." I said, give me 12 articles for the Gray Report. It says, okay, here's 12 articles. And I looked at them. I was like, okay, tell me when they're published. Okay, here they're published. All right, we got it all good. Got the titles. I Googled one. Article did not exist.
Didn't exist. Yeah.
So I said, okay, Bard, can you tell me a little bit more about these articles? I said, give me the name of the publisher. They're like, okay, yeah, here you go. Do you want a link for that? Do you want a link for these articles? I was like, this will be good. Give me a link for that, Bard. And Bard said, no, I can't do that. I'm just a language model. I can't give you any links.
Yeah.
So it lied to me.
It's straight up lied to you. Unbelievable.
And then I said, rephrase your response to be a little bit more defensive. It couldn't be that.
That's funny. So I'm telling you to cite more sources, Matt, which is good. There's so many things that it's like, this is gonna be the end of the show, Matt.
Yeah.
So this is like, so I was asking today, I was like, want to have some morale boosting campaigns. We have a whole new campaign for all exciting stuff going on. I'm like, but I want to do some cool things to get everybody motivated and boost morale. And I've got a lot of ideas, but I'm like, okay, I could think here for 30 minutes and use my brain, which I'm going to do, but give me a head start. Give me the list.
Yeah, this is where that, identified some shortcomings, but this is where some of the stuff where it's like, I am kind of new to this. I'm a little rusty about this kind of thinking.
You're getting ready to start a task. I'm getting ready to start a task. You might as well ask, how do I get started? And I told it, I'm a CEO. I'm putting together a morale boosting campaign for the company. We have 3 divisions. We have this many people. This is a general maybe how much money I want to budget, which really wasn't important at the end. I was like, we've got a family farm that we could utilize. I want to identify for thought leadership and all kinds, different events, daily, weekly, monthly, one-time opportunities. It used the web. It used the web to figure out what was going on in the local area. Mm-hmm. And it put together some team building events with examples of some things that we could do this month, which we are doing one of those things, the 500. There's a big car auction, which probably not right up our alley, but I could ask it to suggest.
Let's spend our budget on getting a car.
But bonuses, contests, prizes, communication and leadership, feedback session, leadership training, company retreat, professional, all this stuff. I've had to do all of this, but I then made a Google spreadsheet and started putting a budget together and a calendar, and I took what I liked and added some more things and took out what I didn't like.
And
it saved 45 minutes, 30 minutes of work.
No, and this is the kind of stuff. Yeah, if you're just entering activity, you want that foothold, and even if you have the idea already, to have it spit out what you like. Oh, okay, then that's a crucial support rather than kind of going out on a limb. It really helps you to not kind of go out on a limb.
I first started looking at just I wanted to name the campaigns.
Oh, that's
like
good.
Some examples of different like morale campaigns across time, but then let's go to the next one. So then I asked for more clandestine operations. And there's some really interesting that they weren't necessarily aligning with what I was going for.
Yeah, these are all war actions.
There's some interesting ones, like Operation Northwoods, Wandering Soul. Anyway,
yeah.
So we're learning a lot every single day in the Gray Report, and so long story short, we're in the infancy.
Yeah.
I think there's gonna be a lot of like custom again, because like a lot of it's like it almost works, but really it's like bringing this into the rest of our tech stack. We're building APIs, and setting the policies around how to best use it, what not to use it. But there's so much opportunity, and again, we're already taking advantage of it. But it's exciting to see what it's all going to integrate. And there's a war right now between OpenAI, Google, and all these other firms, because like Bard came out on Friday and ChatGPT dropped in all their these plugins on Monday.
And Adobe I got the thing for their Firefly, which is okay. But like it does seem like everything's coming. And then Sam Altman was up in front of Congress. It was like, give us more regulation. And I was like, I bet the regulation is like, just shut the door behind me. Now
they were like, can you do it? And he was like, no, probably not, but like I can find somebody. They're like, sure, we know nothing about this.
The plan is to tell you the regulation is going to be you're not allowed to do AI unless you're open AI. That's going to be
that's usually how it works.
Yeah.
All right, Matt, this was great.
Yeah.
Great food for thought. We got, I think, some good pull-out clips. I think the AI thing. So make sure you're subscribed to the Great Capital YouTube channel. Appreciate you watching through this whole thing. Leave a comment. What do you think about AI? What do you think about multifamily industry? What we're saying? Make sure you tell your friends. Give it a share. We appreciate you. Again, if you are an investor that is accredited and you want to see what we've got in the works, we've got some exciting news coming up here. We can talk about the report that's coming up, Matt.
I know. It was a little hit.
That's a damn shame. We need to next week we're going to highlight. We got a report coming out. We got new opportunities. So get in touch with us, greatcapitalllc.com. Make sure you sign up for the Gray Report newsletter, greatcapitalllc.com/newsletter. You're checking up new data every single day at grayreport.com. Any closing remarks, Matt? What do you got for us?
I got nothing really. I can't prompt myself. Stop thinking.
Give my props. Going to say we could have ChatGPT give us an outro, but we'll just leave it at that.
Yeah.
All right. See you next week on the Gray Report.